Good morning, traders. It's 8:02 a.m. Chicago time on the 17th of March 2016. It's a Thursday. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. The overall sentiment overnight with oil being up, gold and silver are very, very strong. I believe as high as 3.5% up following the FOMC yesterday. The U.S. Treasuries, the bonds are up. 10 years are slightly up. The Bund is up. The Nikkei is slightly down. The Hang Seng up. Shanghai up. The Japanese yen is up. The DAX is way down. The FTSE is slightly down. The CAC 40 is down. And the S&P 500 futures are down, as well as the U.S. dollar. The overnight market stance is again, just like it was yesterday, is on a risk-off basis, but prices are still higher than where they were yesterday. We're trading about 10 handles higher than where we were at yesterday's trader bite. Overnight, Norway's central bank cut rates by 25 basis points. The Bank of England left rates unchanged. Initial claims came in at 7:30 at 256,000 versus 268,000. Much slightly better. Continuing claims continue to be online. The current account was worse, a negative 125.3 billion versus 118 billion expected. But also the Philly Fed came out with its business outlook, and it's much stronger, 12.4 versus negative 1.5. So that's a swing of 13.9 points up. This is the highest reading since February 2015. And that's how things are shaping up. The market's still heavy, though. Let's take a look. Overall, the euro is climbing. The European markets are taking somewhat of a hit. The DAX is now down 182 points, 1.8%. The DAX has been down as far as 50 points more, over 220 points at some point in the session. Let's take a quick look just for consistency, as it's important for us to be consistent. Yesterday was FOMC day. And the primary hypothesis is to chop around and test the 95.50. The 95.50 area. That was the primary hypothesis yesterday. Was looking for to drop down to continue the process of moving the point of control down lower. I said this hypothesis, given that we're opening right in value in range, this hypothesis does not have a huge advantage over the second hypothesis. And the second trade idea for the day was exactly what happened. Again, 2 days in a row, Hypo 2 completely in play. Hypo 2 is chop in the middle and then start moving up, with our key target being 2015.75. 2015.75 is the key microcomposite LVN. This is the key area we're testing above. We went through this a couple times, but I'll show you it again. So the 2015.75 is basically what separates the lower distribution from the upper distribution of this profile. So let's, I know there are a lot of lines here. Let's kill that. Let's kill these lines. Okay, so when we look at this, the 2015.75 is this area right here. It separates all of the trading that has happened since August. The rally up through November, December, October, November, December, and then the fallback through at the beginning of the year. And it's the dividing line between the upper and lower distribution of the profile. So if I zoom out a little bit more, you'll see how this area is key. We have the point of control, and the bulk of our volume down below since the August drop. And what we're doing now is we are climbing back above that August drop, and the dividing line is very distinct in this area. Very, very distinct line right here, and that is 2015.75. So the expectation is that the market will likely rise to it as part of the FOMC, and it did on any good news. And the expectation is it'll push through, but then it'll initially fail. It'll likely initially fail through it, and that's what I'm expecting today. So it held above there yesterday. So if we look at yesterday, we had a very typical FOMC action. The market stayed, drifted up right off the open. It was an open drive type of opening, and then it ended up pushing lower. So you could see that the breach of the IB high was very small, just 2 ticks. The breach of the IB low was also very small, just 2 ticks. The market was neutral before the FOMC. The FOMC comes in. We have our initial wave up right into that 2015.75. In fact, it pushed it by 4 ticks to 2016.75, and then it pulled all the way back on wave 2, and then wave 3 was a continuation back up to the high that you're seeing there at 2021. And then the market closed in the upper distribution with 2 very distinct distributions yesterday. We are still stuck in the upper distribution. The expectation was this market was likely to move to the lower distribution overnight, and it's not able to do that. Although the overnight profile shows that this is fairly weak. So here it is. The overnight trade is shown in blue and white. This box in blue and white is the overnight session. The overnight session started out, pushed higher, chopped up to the 2027 quarter. The important thing about the 2027 quarter, it is the gap close. We had a gap zone that we've been carrying for quite some time, and the gap close of that zone is 2027 and a quarter, pushed right up to it, and then has fallen off and has formed a secondary lower distribution with more volume in yesterday's profile, and we are attempting to take it back up this morning. The 2017-2018 area is absolutely important. It is the over underline. This is a key area. It's the mid of the session. It is the LVN in between the 2 distributions. It's yesterday's close. It's just got a lot going for it. It's also that 2015.75 zone. This area is going to be very, very important here. You're going to want to watch it closely when we open today. So based on how the action is and whether or not it pushes through, uses that as a base, chops around and starts moving up, that sets the tone for what we've got into today's session. If we come up to it by the time we come into the open, chop around it, unable to sustain it, push lower, weaker high, and then or a lower high, and then it starts moving forward, starts moving lower, then I'm going to look to target the POC from yesterday below at 2,750, then 2,000, and then we're looking for 1995 again for the rotation, the corrective rotation down. That's how things are shaping up on the overnight. This gap zone here, we are getting rid of it today here. There it is. So that gap zone has been tested from above and from below, and it is done. And you can see that there's this orange line here from December that we're still carrying. So when we go back, this is where the gap happened right here on the first trading day of the year, this huge gap down, and the closing price of last year, is 2027 and a quarter, which is also the overnight high. You want to observe that. The market just found sellers up there overnight. But overall, just seeing a weak cluster all across Europe in the equity side. But the S&P still holding prices up here in what is perceived as value. There's really no value based on yesterday's action. It behaved a lot more like a trend day. Now, I promised a couple people on Twitter I would show what I meant by the three-wave motion that takes place on the Fed. The Fed announcement comes in right here. The scene of the crime for the Fed is 2002 and a quarter. The initial motion is up to 1675. Remember, 1575 is the MCLVN. That's wave one. The pullback to 2005 and a quarter is wave two. This initial motion here is very, very hard to catch. It was a lot easier before 2007, 2006 to catch those. Very tough to catch, and generally it collapses on itself fairly quickly, and I emphasize generally. And then the tradable wave is wave three. That's this wave. That's wave three. That's what I was talking about in yesterday's Trader Bite. You might want to review what I was saying during yesterday's Trader Bite about how the FOMC move generally unfolds in three waves, not two. This has been my observation. There's nothing to back this up. It's a very strong opinion. There's nothing to back this up other than the fact that I've practically never missed an FOMC release. So this wave three gives you the opportunity, and the opportunity for wave three occurred at the mid with a lot of heat. And the idea is you wait for the mid to break through. That is your trigger area. You wait for it to break through, then you're looking for it to consolidate, looking for a base, and then you take the long with that lower low, and in this case the OS being your indication that something went wrong and the market is turning and there is no wave three, which sometimes happens. Sometimes the market will pop straight up and it'll actually end up pushing lower. But yesterday unfolded into three waves like it's supposed to, and then of course you have wave 5, 4, and 5 up here, and then the corrective coming in later. I'm not an Elliotier. I don't believe in that stuff, but I know that the FOMC generally revisits the scene of the crime or pulls back to it, and if it finds a base in there, which it did here, it tends to turn over and continue its move. This is the initial intention, and this is the real move. Once the information is processed and the institutional desks are told what to do with that information as far as to commit funds to the market or whatever. Anyway, just wanted to go over that for a minute. For today, the general idea, the primary hypothesis for today. Oh, can I draw one? Yes. The primary hypothesis for today, we are unable to get away from yesterday's close. There's a significant amount of strength. I expect that the market's likely to struggle with that 2017 area from the overnight, the double distribution area. The default action on the auction here is it's likely to push up, struggle, rotate back to the point of control. That is the default action here, but the S&P is showing a fair amount of strength in the face of what other markets are doing. So I'm seeing some OTF action here, despite the drop in the overnight, and it's pushing me back on my heels a little bit on that hypothesis. I suspect that it is likely that we are going to try to push the closing price from yesterday. We're likely to chop up, and then we're likely to continue to 2033.75, the next point of control up, and to clear the 2015 and start moving towards the upper distribution of that composite composite zone. So as soon as we do that, we start pushing for this 2064 MC point of control. We start moving towards the upper distribution that we left behind from the October through January run, and that's the next big target. So what I'm saying here is that we start to break up and reach for that higher distribution, reach for this high volume node. That becomes our next big target. Next big target for what we're doing next. Okay, so there's a lot that's covered there, but the primary hypothesis is likely to be a close of the gap, chop around, and I expect buyers will likely come in and push this through to 2033 and into this high volume node that's just above at 2040. That's hypothesis number one. Hypothesis number two is it pushes through, chops around, is unable to sustain those prices, and starts moving towards 2007.50. And then continues to fall lower into the 1995 being the key retest area. This area has a local weak low and has a former high and is a pretty important support area now, but it's got a local weak low here between the 11th and the 15th, and I suspect that this area is likely to break. Again, looking for the run to 79.75 is the key component. That would be hypo number two. For day traders, this is the bigger hypothesis with a better opportunity for movement. The hypo one with the grind up is not ideal, but we'll take what we can get. Anyway, I'll leave you with that. That's what I had for you for today. S5 traders, we have our AMA. Please submit your questions before 11:30 a.m. You'll have the invitation in your mailbox shortly. Take care.